Yesterday on our weekly webinar known as the Options Tribe, we had a guest by the name of Terry Lieberman, who is with a firm called ExceptionalTrader.com. And Terry focused on core trading skills that every trader must develop. And it was a really, really interesting presentation. Anytime Terry speaks, you should tune in. And yesterday, he brought up a really interesting point coming from a field you wouldn't expect, which is baseball. He talked about Ted Williams. Now, Ted Williams, for those of you who are too young to remember, actually he was before my time. Ted Williams was widely considered the greatest baseball hitter of all time. He was the last person to hit 400 in a season, which is mind-boggling. You know, imagine in this day and age a player getting up to bat and getting a hit basically every other time he got up. It's almost unbelievable to attain that, and he was the very last hitter to hit over 400. That happened in 1941, to tell you how difficult this feat actually is. Well, Ted Williams was a student of hitting. He was almost a scientist in the field of hitting, and he actually wrote a book called The Science of Hitting, which is really a classic in sports literature history. And I've never read the book myself, but I've heard people discuss it and seen charts and so forth from it. But in the book, he breaks down basically his own self-analysis of hitting and offers great suggestions for people who want to become great baseball hitters themselves. And so what he did was he took the strike zone and he charted exactly where he hit the ball best. So you'll see in this chart here what Ted Williams calls his happy zone is the area where he hits between 380 and 400 a year. And then he also points out the areas where he's weakest, where he bats in the 200s, and that's actually low and outside for him. Ted Williams was a left-hander, so the right side of the chart is actually low and outside for Ted Williams. It's not too big of a surprise that if the ball's right down the pike, he's going to have his best batting average. But what's interesting is that he was able to break down where his strongest and his weakest parts of the zone were, and he did this scientifically. The part in the middle where you have the most red and orange, basically, those are what he calls the happy zone. And to make it very simple, he tried to avoid swinging at anything in the sad zone, I guess you'd call it. And he, of course, always tried to swing when the ball was in his happy zone. Well, this happy zone concept has applicability to trading and investing. Basically, number one, personal report card is critical to success as a trader. And Ted Williams created his own personal report card related to areas of the strike zone where he swung best. In fact, this year, 2018, we've implemented a goal-setting process for all of our traders, which will include a monthly self-graded report card in which the trader analyzes how he did against his stated goals for the year during that particular month. So it is very, very helpful and a sign of success or likely success if you do, in fact, analyze what you're doing, take a hard look at the way you're trading, and issue yourself a report card every month to see whether you, in fact, traded the way you expected to and the way that would have met your standards. But secondly, there's another thing that the Ted Williams analogy suggests, and that is that putting more of your capital into the trades that you trade best is a very good idea. So think of it as you keep swinging at the pitches that you have the most likelihood of hitting well. And so this is a very important principle in terms of sizing your portfolio of options trades. Now, there's a guy named Warren Buffett who knows a thing or two about investing. Let's hear what he has to say about the use of the Ted Williams happy zone concept. Buffett says, we try to exert a Ted Williams kind of discipline. In his book, The Science of Hitting, Ted explains that he carved the strike zone into 77 cells, each the size of a baseball, swinging only at balls in his best cell he knew would allow him to bat 400. Reaching for balls in his worst spot, the low outside corner of the strike zone, would reduce him to batting to 230. In other words, waiting for the fat pitch would mean a trip to the Hall of Fame. Swinging indiscriminately would mean a ticket back to the minor leagues. So Warren Buffett sort of sees this concept as well, and that's why he's such a great investor. He's incredibly disciplined and only invests in things that are within what he considers to be very high likelihood of success investments. Well, why should you trade on a day-to-day business any differently? Why should you trade strategies that you're not comfortable with and haven't had sustained success with, as opposed to putting most of your capital into those which you've had the most success with? Personally, I split my capital up each month into 6 trades. 4 of them are essentially the same trade. I just apply my capital at different times. I initiate the trades at different times, and I also use different indexes. I don't just trade a single index, I trade multiple indexes, and I start the trades at different times. I do this in order to split my capital up so that I am not, so that any one trade can't hurt my entire monthly result all that badly. So that particular strategy is not only 4 of my 6 trades, but it actually is 90% of the capital that I apply every month, 90%. So I am swinging into my happy zone 90% of the time in my trading, because this strategy has been the one that has given me the most sustained success over time. So naturally, I'm going to be pouring most of my capital into that strategy. Why not 100%? Because I'm also a growth-oriented person, and I try to experiment with new strategies. You can experiment through back testing and paper trading, but there's nothing that replaces live trading. And so once having back tested and experimented with a strategy on paper, I then will take it live with a small amount of capital. And so that will be more speculative and maybe not as profitable as my 90%, but the learning experience will be extremely important, so that if I decide to adopt that strategy, I will be able to do so in a larger way once I've gotten the kinks out of the strategy, understood the execution, etc. So 10% I do swing outside of my happy zone, but it's for a particular and a thought-through reason. It is not simply sloppiness. It's not sloppiness at all. It's very intentional. It's to give myself live trading in something that I have a lot of confidence in, but not quite enough confidence to build a large capital position in it. So my advice to you is stay in your happy zone. It is important to diversify and grow your knowledge, and there's nothing better than live trading to do that. But during the learning process, you've got to keep your capital level small in your experimental strategies, because what you don't want to do is screw up your ability to make the amount of income that you're expecting to make from your trading in a particular month while you're experimenting with a particular strategy that you're not that comfortable with as yet. Don't do that. Give yourself a continued momentum of success in your trading while dedicating a small percentage of your capital to smaller strategies that may or may not work. If they do work, of course, you have the option of then taking them larger. If they don't work, you haven't lost that much in the process. So that's my suggestion. Give yourself continuous momentum by swinging in your happy zone, not being afraid to take a couple swings outside of your happy zone, but when you do that on a small amount of capital. That'll give you the ability to have sustained success while growing and learning new and different strategies. Thanks very much.